Hello and welcome to another TLC Tutoring Company accounting lesson. In this lesson, we will be going over a differential analysis for a lease or sell scenario. So your textbook might decide to set up these differential analyses in a very particular way by using a table. I'm just going to be focusing on the important part of this type of lease or sell analysis. So in this problem, we have Gage Incorporated that currently has a piece of equipment with a cost of $200,000 and accumulated depreciation of $80,000. So we see that there's a book value of $120,000, but that's kind of irrelevant here. That's already a sunk cost. They are considering selling the equipment for $95,000. So there's one scenario, we could sell it. But also management believes that the equipment could instead be leased for $19,000 per year for 4 years and then afterwards be sold for $30,000. So we have a little residual value there. Now during the 4-year lease, we're obviously going to have to pay some type of costs to upkeep the equipment. So it says here that the expected cost of maintenance and insurance will be $15,000. And that will be a total, it looks like. Yeah, that's a total. So we have all these different numbers. We see that we can sell it for $95,000. That's actually going to be one of our easier portions of this. So first option, sell it. And we have a sales price of $95,000. But our other scenario is we could decide to lease it. Now, this is where it's going to be nice to kind of keep things organized. If we sell it, we're obviously going to be getting $95,000. But if we lease it, we are going to be getting some lease payments. So we could say, let's call it payments. Remember, we're not the ones paying it, though. We're the ones receiving these lease payments, since we are the lessor. So we are going to be getting $19,000 for 4 years. So we are going to be getting a total of $76,000 for those 4 years. So far it's looking like it's better to sell it, but let's keep going. It also says that after the 4 years, we can sell the piece of equipment for $30,000. So that's our residual value at the end of the lease. We could also get $30,000 at the end of that. So we lease it for 4 years and then we get to sell it for $30,000. Now, if this was the only information involved, you can kind of see leasing is starting to look better. However, there is one more piece of information. If we do lease it, we are going to have differential costs here as well. We are going to have to spend $15,000 over the term of the lease. Remember, that's not annual, that's total. Over the term of the lease to maintain it. So let's go ahead and include that as well. Now remember, since this is a cost, this is a cash outflow, so this will be negative. So we have to pay $15,000 in order to maintain this equipment. So all in all, if we take a look at everything, let's go ahead and net those three numbers. It looks like we are going to be getting $91,000 for leasing it. And here's where you get to go ahead and analyze your two scenarios. If we sell it, we're going to get $95,000. If we lease it, we're going to get $91,000. So even if we were going to do some type of time value of money analysis here, which is a little advanced for what we're trying to do here, we can see that selling it is the ideal because we make more money from this. So take some time to pull out a piece of paper and do this again. Make sure that you understand where all of the different numbers are coming from. Probably the hardest part of these types of problems is organizing your thoughts and comprehending what you're reading. So remember to go slowly as you're reading through those paragraphs. Right? Until next time, happy studying.